Lou Simpson, who of course ran for many years Geico's portfolio for Warren Buffett, said at one point, concentration may be the only way that I can add additional value to what I'm doing for the Geico portfolio. So he also was a great believer in this concept of concentration. Tell you another story, which is one of my favorites from the book. This is about Glenn Greenberg, who very successfully ran a investment firm that had usually around four positions in it. The firm was called Brave Warrior, and it compounded in the very high teens over a very long period of time. So Glenn Greenberg was an English major at Yale, and he graduated and managed to get himself a couple of what he called money mismanagement jobs. So he started out with some big Wall Street firms doing effectively what at the time would have been similar to what we call day trading today. He found that not to his liking, and he finally linked up with a fellow by the name of Arthur Ross, who ran an office called Central National Gottesman, which invested the fortune of a well-known New York family, the Gottesman family. And Arthur Ross is described by Glenn Greenberg as just being a brilliant investor who nobody has ever heard of. So, and the reason he had never heard of is he had no desire to be known publicly, and he also worked obviously for this family office. So in any case, the story that I like is one day one of the Gottesman family children, young adults, came into Arthur Ross's office, and he said, Arthur, I'm thinking of going into the money management business too. Tell me what your secret is. And Arthur, who was known for not tolerating fools too well, said, tennis shoes, now get out of here. Young guy sort of ran down the hall with his tail between his legs, and he saw one of the senior analysts that worked with Arthur Ross in the hallway, and he said, I just went into Arthur's office and I asked him, what's the secret of your success? And he told me tennis shoes. I don't understand what tennis shoes has to do with investing. And the analyst smiled and said, what he said was 10 issues. You never want to own more than 10 issues. So that's another point towards concentration. It'll keep in the back of your mind that you want to always wear your tennis shoes. Buffett, actually, Lou Simpson arranged for Glenn Greenberg to have breakfast with Buffett for his 50th birthday. And Glenn Greenberg had just invested over 30% of his portfolio in cable company stocks, Shaw Communications and TCA Cable and so on. And he was very curious to discuss with Buffett what he thought of this investment. And so he sat down with Buffett, and they barely had started to have their breakfast, and he said, listen, Warren, I want your opinion of cable stocks. And Buffett said, no cash flow, waste of time. And basically just dismissed the thing out of hand, which was not a good start for the breakfast. But in any case, to Glenn's credit, he did not rush out after breakfast and sell all of his cable stocks. He kept them, and it turned out to be, at least for quite a long period of time, a tremendously successful investment with him. And I think what this points to is the fact that you've got to really be somewhat stubborn, and you've got to really be somewhat overconfident to be successful as a concentrated investor. Now, both of those characteristics can also get you into a huge amount of trouble, but what Glenn demonstrated by sort of not following Buffett's advice was that he was willing to believe in his own judgment and basically make an investment that he was advised against by probably one of America's greatest investors at the time. So that requires some definite confidence. The other thing that was going on at the time is that Business Week had just had on its cover the picture of a satellite receiver, and it had published the headline, Satellites, the Death of Cable. So the other thing that you have to be willing to ignore, tremendously importantly, probably wiser to ignore the press than to ignore some of Warren's suggestions. So the next person that we'll talk a little bit about is Christian Siem, who probably is the least known of the people in the book to you. And originally we tried to set out to really examine investors who were not well known by the American public and sort of understand what they did, because there have been a gazillion books, as you know, about Buffett, a gazillion books about Munger. If it had been my druthers, I wouldn't have even put chapters about them in the book. The publisher, on the other hand, said you can't publish the book unless you talk about Buffett and Munger, so they snuck their way in there. But you know, I don't think we added tremendously much to the knowledge about Warren and Charlie Munger, but hopefully we added something to some of these lesser-known investors. So Christian Siem, who's a Norwegian investor, really runs a family holding company rather than an investment partnership, has done almost all of his investments in two industries, which are the oil industry and shipping. Again, runs a very, very concentrated portfolio with about 5 positions at any given point in time. And like all the other investors in the book, has just a spectacular track record. From 1987, when he started with about $5 million, he earned a return of over 30, I think it was about 34 point something % per year compounded, and ended up in 2014 with well over $2 billion in assets. So just spectacular returns, which is not to say he didn't have his share of mistakes. And one of my favorite stories about Christian is that he actually, when he had done most of his work in deep sea oil up until this point, he was getting into shipping, and there was a very well-known London-based shipping company that was a blue shoe shipping company, and he decided, they were having some troubles, he decided he would try and rescue it, and that did not end up working out so well. And the mistake that he admitted to making when he spoke to us, he said, you know, I was very impressed by the reputation of these people. You know, they were British, upstanding, all the good things one can say about the Brits. And, you know, for me, I felt like it was, you know, a step up in reputation to own a piece of the shipping company. But what I neglected to do was to inspect the ships. And what I discovered when I inspected the ships, that they were in complete disrepair except for the officer's bar. The officer's bar was in great shape, but the rest of the ships were basically falling apart. And he finally managed to extract himself from that investment, but it took a tremendous amount of time and effort, and didn't result in any return. So what Christian said to us is industry by its nature is long-term, and the fund business is by its nature short-term. Financial investors come in and out. They can push the button any day and get out. The principal industrial investors don't have that luxury. They have to think for the long term. They believe, indeed, the success of the industry is that you always think long term. So even if incidents like mergers or takeovers cause you to be out in the shorter term, you take the long-term decision or you take the decision as if it was long-term and as if you will be the owner of the business forever. That is healthy for industry, and that is healthy for the shareholders, and I believe it is also healthy for your returns. And finally, he takes this long-term view as being the main factor in the success of his organization. So, some people that we spoke to focused more on the concentrated aspect of the portfolio. Some people focused more on the long-term nature of their investments. And the final thing I'll talk about today is Grinnell College, which some of you may be familiar with. It has the highest endowment per student of any college in the United States, probably any college in the world still. Its endowment was run by Joe Rosenfeld, again, who happened to be a friend of Buffett's, but not so much because they talked much about investing, but because they both were baseball fanatics. So that's how they built their relationship. I'm sure they talked a little bit about investing too. And Joe Rosenfeld is known for saying, when you buy something, you want to pretend as if you're going to put it in a safe deposit box and forget it forever. And that's the strategy that he used in doing the Grinnell endowment. He expanded on that and said, do a few things well. He built the billion-dollar portfolio not by putting a little money into everything that looked good, but by putting a lot of money into a few things that looked great. Likewise, if you find a few investments that you understand truly well, buy them by the bucketful. Sit still, have patience. One of the people who's on my board is a fellow by the name of Allen Kahn, also a very well-known long-term value investor. You probably have heard of his father, Irving Kahn, who passed away recently at the ripe old age, I think, of 109, after having worked on Wall Street all of his career and having gone to work pretty much every day until he unfortunately passed away. So Allen Kahn uses the term Sitzfleisch, which is the German or Yiddish term, which means sit on your hands. And he always is saying these young investors don't have enough Sitzfleisch. They don't have the ability to sit patiently and let their investments mature. So Rosenfeld said that his time period was measured not in years, but in decades. And that long-term view is, in fact, he felt, an investor's single most powerful weapon. And he has a number of examples, which we give in the book, of investments which took incredibly long time periods to work out for him, but when they did worked out hugely well, and he had the patience to sit through them. The other thing that Rosenfeld said, and I think it's good for all of us to think about, is he said, invest for a reason. If you're a good investor, you're going to create wealth, and you want to think about how that wealth is going to benefit not only yourselves, but the rest of humanity. He had a very unfortunate life in that both his wife and his only child passed at an early age, and he worked his entire career benefiting Grinnell College, and then he left his entire fortune, which was quite a large fortune, to Grinnell as well, because he was a great believer in the benefits that Grinnell would bring to the student body. So to sum up, what some of the lessons we've learned from these great investors are: invest with a high level of conviction out of optimism but not out of fear. Expand your time horizon significantly. Some of these investors, and I'll let you read about this in the book, also did trade around their positions. So Lou Simpson in particular invested in Nike, and you almost get a feel for a stock after a while, and you sort of know when it's overvalued and undervalued. And if you get that feel after huge experience with owning a stock, and Lou owned Nike for years and years and years, you can actually sort of get a feeling for when the stock is overvalued. I mean, obviously you can look at the metrics too, but you need to really have a sense as to when to trade in and out of the positions. And finally, concentrated investing, for those of you who are in the money management business, is a terrible way to manage money, because you're going to lose all your clients, because you're going to have huge volatility. So what a number of the people we profiled said is, this is a great way to create wealth, terrible way to manage money if you have outside shareholders. What you really need to have is some form of permanent capital. And all of these investors, to a certain degree, really did have permanent capital. Geico, for example, obviously you had the insurance float from Berkshire, and Christian Siem basically built his own permanent capital from scratch. Glenn Greenberg also largely built his own personal capital, not entirely from scratch, since his family actually owned Gimbel's to begin with. It's very hard to have the type of volatility that you're going to have as a very concentrated investor and keep normal clients happy. So there is sort of a conflict there. And with that, I'll throw it out for questions. Thank you.